In this lecture, I'm going to show you how you can use Fibonacci extensions to determine possible areas of support and resistance. I want to start with the S&P 500. This is a monthly chart that goes all the way back to around 1990. Now, as you can see, there have been three tops so far. The first one occurred during the bubble of 2001. The second one occurred during 2008. And the third one may have just occurred a few months ago. So let's take our retracement tool in Thinkorswim called Fibonacci retracements, and we're going to draw the extension. So as you remember, an extension goes from A to B, and then it extends past A to C, and you'll see it here. So if we draw from A to B, you can see that our C, which goes past, is going to be first the 127.2, and then it's going to be the 161.8. And the 161.8 roughly coincides with the top of the market. This isn't an exact science, but a lot of people put quite a lot of belief into it. Let's go on to another example. Here is Apple on a monthly chart. And if we do the same thing again, going from A to B, you can see that the 161 extension is where the price of the stock was not able to push through into making new levels. So how can we use this in our daily trading? If we can see that drawing from A to B will give us a point C, what can we do with that? Well, let's take a look at this chart of Apple. Here we can see that there was a down move a few days ago, and Apple had a nice big up move going from 107 all the way up to 119 for a gain of 12 points. After that, it topped out, and now it's come back down to 115. So if you were buying Apple down here in the 110 range, you'd be using your Fibonacci's to determine how far a move Apple would make, in this case, the 127. And what you would use this for is to determine when you would get in and out of a trade. So say Apple comes down, bottoms out, starts to consolidate, and looks like it's going to make another move up. At this point, you can come in and buy the stock, or sell options, or buy options against it, and then ride it up. When it hit the 127.2, you could take all of your profits or half off the table, just to give you that security of having made a profitable trade. Here's another example of how you could take a trade. Here's Accenture, and if we draw from high to low, you can see that when Accenture made its move up into the correct direction, it consolidated and it hit resistance at that 127 level. So if you bought Accenture down here while it was consolidating and then it made its big move up to this 127.2 level, here would be the time to take profits off the table. Here's another example of how you can use Fibonacci's to determine when you take profit. Take a look at Amgen. Had a nice move up in the past 20 days, oversold a little bit, came down, bottomed out, came up, bottomed out, came down again, and right now it's come up and it's started to consolidate here. And if we take the high to low from A to B, what extends to C at the 127 level is where the consolidation is taking place right now. So here at 158.45 would be a good place to take profits had you gotten in down here. Here's another example with Boeing from just a few days ago, where if we take the high to low, you can see that when we get rid of these, it comes from high A to low B, comes back up on the retracement, consolidates, and then pushes forward again. And the place where it goes to is the 127.2 extension level. So this is good. So if you're buying options, or if you're just buying the stock, more so with buying options, you need to have a price target of where to get out of the trade. Fibonacci's in this respect allow you to do this. They allow you to see where the 127 is, and if it's consolidating And if it's hitting resistance at that 127 level, you would probably want to take most of your profits off the table. If it keeps on pushing through up to the 161.8, then you want to keep it on. And once it gets up to the 161.8, then you could take profits off the table. It's all just a matter of looking at the stock and finding out what you think of it, and if you think there's good movement to be had. Here's another example, going from high to low, swing high to low. We have a 161.8 at 16.57. The high was 16.55. So you can see here that the high itself was going to be within 2 pennies of the actual top of the 161.8. So that gives you a nice good area of where you could get out for this trade. And you would make, if you had gotten in at the consolidation period right here, that would have been 40 cents on your trade. Here's another example on an hourly chart. If you take from high to low to high, you're going to see that your price target first would be the 127.2, where if we zoom in, you can see that from high to low, first target would be 127.2, came up, touched it, came back down, consolidated, and then came back up and broke through the 161.8, which would be a good point to get out, at least for a short-term trade. In this case, on MetLife, you can see that there's actually two. So if we go swing high, swing low, we're going to get this consolidating area where the stock has ended up now. And then we can also go from swing high to swing low and see that this 261.8 actually was right around the top of the actual move. In this lecture is that by using an extension and going from high to low to high, or low to high to low, can give you points where once you get into a trade, you have an area where you should get out and take profits. It doesn't have to be all the profits off the table. You can get to the 127.2 extension and take, say, 50% off or 70% off, and then let the rest of it ride until you get to the 161.8. But the Fibonacci's allow you to create some discipline in price targets of what you want to achieve.